Okay, so welcome back to the Default Global Podcast. Today we have a truly exceptional guest, John Corrigan, co-founder and COO of Kurve, which is an AI-powered developer tool that is changing the way data discovery and feature engineering are done. John is a serial entrepreneur and executive with over 18 years of experience. In his previous company, Summit Sync, was successfully acquired in 2020. He is also deeply involved in the climate tech space as a venture partner at Remarkable Ventures, and he mentors startups through the Entrepreneurs Roundtable Accelerator. Yeah, we're excited to hear about his latest venture, Curve, and dive into his fundraising journey. John, did I miss any important information in that introduction?
No. Yeah.
Okay, cool. So, Jen, I'm personally obsessed with finding awesome problems in high value niches, where's the both complexity and a lot of money on the table, you know.
Yeah.
So, can you share the story of how you identified and validated this problem, right? So, yeah, maybe let's start with the problem you're solving with Curve.
So with Curve in particular, right? My co-founder turns out is a guy who interned for me a decade ago in 2013 when I was babysitting a startup that had started after the Obama campaign by their data science team. He was our first intern. Brilliant guy. It was his first internship in his first data science internship. Curve's problem is a unique one that has been percolating for some time. You had all these RDS databases, right? So that had file systems or schema attached to them, right? And they became very cumbersome and expensive. So corporations were like, okay, we need to reduce the size or the cost around managing and building databases. So they went from the database paradigm, the RDS databases, to data lakes and data warehouses. And they basically just set up dumping grounds of data, right? For production, analytics, development, what have you, right? And the explosion of sort of big data starting, and I would say really started to get going around 2013. You lost your schema, right? So what's in my database? How's it connected? What can I do with that? And with the emergences of like AWS, Azure, Snowflake, Databricks, Google BigQuery, things of this nature, right? Like, hey, how do you figure out how to do automated data discovery? Because data discovery is currently done by humans and it's hand done, right? Or there's labeling, but labeling is still someone on a keyboard and your data is changing constantly, right?
Yeah.
So Curve was a spin out of Stanford Research Institute and the Department of Defense and DARPA, who had been doing this research for the better half of the last decade. And my co-founder, Wes, was an entrepreneur in residence there. So like, hey, listen, I need somebody to manage the business side. Would you be willing to be my co-founder? And turns out we lived down the street from each other in Miami, and we spent a lot of time sort of getting to know one another, figuring out how we align both personally and professionally. And it made sense. And so I love Curve's problem because if you want to adopt AI and machine learning at a high rate and high performance, you need what Curve does, right? So the TAM is very large and it's very relevant within that TAM. How do you get a lot of technical folks, business folks, and product folks on the same page in an organization? And because Curve produces a graph of your data, right? The organization can talk off one sheet of music about what's in our database, what's not in our database, how's it all connected, and what's possible, right? And then you can prioritize and make decisions around what do we build, why do we build it, how do we build it, how do we get more models out faster? So there's sort of three things in that paradigm. There's ideation, experimentation, and production, right? Currently only about 15% of AI experiments make it into production, and that's extremely expensive. So inverting that production ideation paradigm and that experimentation paradigm of like, okay, how do I get 50% of the models that I experiment with to production? And Curve enables that, right? Because you can find data faster, you can understand its value, how it's connected, how it's not connected, to build models, whether that be a churn model or a recommender system or varying degrees from there, right? So that is Curve, and we've got a bunch of customers, and we're sort of doing a lot of hand-to-hand combat with those customers at the moment, moving towards a self-service paradigm. We will still continue to engage enterprises, but we want to get Curve in the hands of more developers to do data science, or excuse me, automated data discovery and automated feature engineering faster. So, in terms of fundraising, which I think is the thing that you want to talk most about.
Just before that, speaking about this bunch of customers, can you maybe share some numbers you're comfortable? No. No. Okay, so let's then jump into the fundraising part. So, you launched Curve early this year, right?
Yeah, we launched Curve publicly late this year.
So this year.
Yeah.
Did you already raised your pre-seed round? Yeah.
Well, we raised what we would call friends and family.
Friends.
We probably won't do a pre-seed round. We'll jump right to seed or Series A.
Okay.
And so we will likely target somewhere in the $7 to $10 million range to support growth of the business, because we're just scaling faster than we thought.
Okay, that sounds good. So, but still, you're an experienced entrepreneur, so that's your not the first venture, right? So, was there anything about this a fundraising journey felt different compared to your past experiences with, for example, Summit Sync?
Yeah, I think Summit Sync, when we started Summit Sync, there was a lot of fairly sophisticated SaaS investors, enterprise SaaS investors around marketing technology, which is really what Summit Sync is at the end of the day. So sales enablement and marketing tech. I would say there's a lot less sophisticated investors around AI and machine learning, right? There is, in the world of machine learning, I would say there are probably half a dozen to a dozen serious investors who know the nuts and bolts, hands-on keyboard, what data science and machine learning actually are, right? How do you spin up a Spark cluster? How do you work in Databricks? What is the AI machine learning assembly process? What is model tuning? And there's a difference between theory and actually doing. So the hands-on keyboards folks who've been data scientists, right? So filtering out folks that can talk a good game versus actually put their hands on keyboard and know the details, especially given where the cycle is really, really important. You also sort of want to target funds, if a venture firm is on fund 2 and they're like, hey, we're more than just our capital, and it's a sub $100 million fund and 4 to 6 people, that's not they're not a business yet. So you want to be very careful about, if you're building a scalable venture-backed business that has the opportunity to make tens, if not hundreds of millions of dollars, who you choose as your partners very early matters a lot, right? So does the firm have, strong operating partners? Do they have real portfolio support? The number of bodies that they have with subject matter expertise inside their organization matters, who are employees and partners, not just, hey, we've got an advisor who will talk, right? Those things are super, super important. So I think, as an entrepreneur, vetting who your partners are, and not just taking anybody who offers you money, is super duper important. And I think cap table construction, your product can be amazing. You can build an amazing business, but if you don't get your cap table dynamics right, you can severely harm yourself financially, but you can really handicap the company, because a later investor can come along and say, listen, business is great, product's great, but we don't want to do the cap table violence, and reorient and restructure the cap table, because it's going to be too much money and too much time, et cetera, et cetera. So you're no longer an investable business. So I think that's one thing that first time entrepreneurs make the mistake around. I certainly did, about not paying attention to cap table construction, and also who your partners are and what their intent is. Do they say, hey, I want to put $50 million into this business and I want 100x return, or I want to potentially go public or build a massive enterprise, or hey, I'm really happy if I get a 2 or 3x return in a couple of years, and getting them to tell you that very honest conversation, and getting into like how their portfolio is designed, right? Because how you make your first 5 bets out of a new portfolio or a new fund versus how you make bets 21 through 25 are totally different. So where they are in the deployment cycle, how their fund is doing, what their MOIAC is doing, um, you know, do they have LPs that are in multiple funds? If they're in multiple funds, what those returns look like, how the company health is doing, in the companies in those portfolios are doing, because that will affect you. Um,
Okay.
so like doing a very serious level of due diligence on the fund itself, the people, the construction of their portfolio, who their LPs are, things of that nature, which most entrepreneurs don't do. Um, and you have to remember, like, these people are there to serve their LPs first and you second. Um, you need to figure out how to align sort of those 3 groups, if they're LPs, them, and you. And if you can stay in alignment and the business is going well, you'll make a lot of money. And if you don't, you can end up in a different place. So
Yeah.
um, these are not small matters.
Yeah, 100%. I mean, yeah, you're not just a founder, you're also like an experienced investors or remarkable ventures. That must give you kind of some real advantages when
Yeah.
it comes to fundraising, right? So, you mentioned this couple of things in terms of cap table and other, but maybe something else. What specific insights or knowledge from being on the investor side do you think helped you like raise money for, yeah, maybe not for this round but for previous rounds with your previous ventures?
Yeah, for sure. I think, one of the things, having worn both hats and still continuing to wear both hats, right, is I much prefer to be an operator and a founder than I do an investor.
Mhm.
I think Remarkable is one of the most um climate forward, interesting approaches to decarbonization of the enterprise, and is going to make a ton of money. And that thesis has been developed over a decade and a half with a track record from ERA that is second to none, just not marketed very well, if I'm being quietly blunt about it. John Axelrod and Marat at ERA have done incredible work to build companies and build founders, of which I'm a very proud alumni. But yeah, I think that, you know, having had the investor hat on, understanding how much portfolio construction comes to play when you're making investments, how much belief in the founders to build a great product and to be able to sell it, right? And then, hey, how much time can you give each of your children given resources, right? Every investor will tell you they're more than the money, and that is not a true statement. So, um, how you as a firm in the platform that you're building as an investment shop can actually do real tangible work to support your portfolio companies, right? And that's why you see the cream of the crop stay there, like the NEAs of the world, the Excels, things of that nature, who are like, hey, listen, we are going to get intimately involved in the building and the construction of these companies. Um, so, and you see like the firm that I really love is Zeta Partners, right? They got a very specific focus in data science and machine learning tools and AI, because all of the partners at that fund have been hands-on keyboard folks who are subject matter experts with recency in their field that they're investing in, and these are people who worked in industry and then started a fund. Um, so and have started businesses, right? So you're like, hey, they've been operators, they've been founders, and then they became investors, and they invested in something that they know intimately over 2 decades, right? So they, as a smaller shop who've only got a dozen folks, can be incredibly successful because of their focus and experience. Whereas I think a lot of these generalist funds that raise a small starter fund and then raise a sort of medium-sized next fund, but are generalists, like they remain small because their fee structure is small and they can't support a lot of talent. They just don't break out. Um,
Yeah, yeah.
so
Raising capital is always like a always requires a lot of effort, a lot of time. And one of the most important question is it the right time to raise, right? So, what can you recommend to founders? Should they already have a certain amount of traction before reaching out to investors, or should they focus more on the vision and potential of the product and pitch that part? So, what is your recommendation here?
Yeah, I think it's really cheap to build companies these days. And it's cheap to build companies these days. It's easy to get customers, or at least like some customers going, right? So you sort of want either if you're a very product technical team,
Mhm.
you want the product and you're not very strong sales wise, and you're sort of younger in your career. You want to have you really want to lean in on a more developed product or a more advanced product and go through that cycle, right? If you are sort of like Wes and I, my co-founder, we both have built businesses. We've run businesses both with capital, without capital. We can build products. I can spin up all the go-to-market stuff. So we sort of don't need to raise that much money, and we can wait later till the business is more developed. But that's almost 20 years of experience between the two of us. Or him about 15 years and me, I'm almost 20.
Mhm.
So, but if you've got a great idea, you got to either have product or you got to have customer traction. So, and like ERA, great accelerator, Y Combinator, great accelerator.
Mhm.
So if you're sort of like first time out and you're like, listen, I need to learn how to be a founder because it is something you have to learn. Those are wonderful platforms and programs to go be a part of. And it'll just sharpen your skill sets, right? But yeah, I would say, um, definitely you got to get a product together these days. You got to get to MVP sort of before you raise money, unless it's deeply, deeply technical or you're like over the horizon doing future
Yeah.
tech, but you come from a place of you have a PhD in something or you've spent 20 years in that industry and you're a subject matter expert. Um, or you have to have a bunch of, a bunch of customers like, listen, what I'm selling is the problem is so big and so painful that someone will buy it now and this product is terrible,
Mhm.
but they'll buy it because
Yeah,
their pain
we
is
need
so
to
big.
solve this problem. Yeah,
Yeah. So,
exactly. Okay.
um, and then also like on the, hey, when you need money, I don't know how many thousands of venture capitalists there are in America or globally at this point, but like spend more time doing targeting and filtering because you can spend a lot of people who tell the stories of, oh, I talked to 150 investors and 149 of them told me no and one told me yes. You're like, well, here's the thing. If you knew that investor likely on the 150th was
Mhm.
looking for you, and if you spent the time to look for them first, you probably wouldn't have had to have the 149 meetings. So like understanding the targeting side of it, like in the world we play in right now, there's 6 to 10 investors. We know them, they know us.
Mhm. Mhm.
We're going through that kind of cycle, and we've got an opinion on who we want to play with and who we don't want to play with and why. And they probably have the same on us. Um, so I was talking to like an EV company the other day, and they're like, yeah, we've got 20 VC meetings lined up. And I was like, okay, 19 of these are terrible because
Okay.
they don't get, cars, and they don't get automotive, and they don't get transportation, and they don't have anything in their portfolio that would suggest, or anyone on their team with a subject matter expertise. So you're basically saying to someone, bet on me because you think I'm going to win personally, right? Which sometimes works
Mhm.
a lot, but the one firm in that 20 that these folks were targeting, like they only invest in automotive, they only invest in the EV space, right? And they have subject matter expertise. The 3 guys there all worked in big auto for their
Mhm.
whole careers, right? So
Yeah.
call that guy first and then go to the other 19.
Yeah, and speaking about that 150 meetings, I've been tracking the fastest and slowest pre-seed seed rounds this year. The quickest one closed in just 3 weeks with only 4 meetings. While the longest one, I know if you saw my previous episode, it took like 18 months and over 150 meetings with different VC firms.
Yeah, and so like the press puts out this sort of narrative of, hey, they got together for coffee and then they gave him $50 million. That is not how that works, right? Um, in New York
I,
and
I,
in
I
San
had
Francisco,
such a story like in my previous episode.
yeah,
you know.
like in New York and San Francisco, like if you're doing cutting edge stuff, whether you're working at a company or part of an academic institute, and you're in the sort of arena around venture capitalists and technology and all those things, like, and you're going to meetups and you're out in the community and you're a participant in the marketplace, most of these people know each other, or they've been friends for years, or they have friends of friends,
Mhm.
or hey, I want career advice, right? And VCs at the end of the day, if they're really good VCs, are constantly meeting new people and constantly building relationships because their world works on asymmetric information, right? Non-public, person to person, right? So, you know, a deal gets done like that because the partner had been meeting with that person and knew them as part of their community for years, if not a decade, and is like, okay, I know what that guy's career was at, this place. He worked with so and so who also is part of my portfolio company. And we invested in this idea and this thesis, and this guy's been working on this for years. So okay, now he wants to go start a business. He or she wants to go start a business. All right, great. Hey, they're gonna come to them for career advice. Like, okay, they've already known them for years and years and years, right? So this is what, for like me and Wes, fundraising isn't easier, but it's a lot less time consuming because I have a decade plus of relationships with folks
Yeah.
who have been very gracious to give me advice, and I've gotten to know them and what they're up to and all that fun stuff.
Yeah. So, as a venture partner, right? You're also involved, and you touched this a bit in climate tech, right? Which is
Yeah.
a space that is getting a lot of attention lately. So, can you maybe briefly tell us what's happening in that niche from startup and investor perspective? Because typically the returns in climate tech are often slower and more uncertain. So,
Yeah, absolutely.
yeah.
I'd say there was like a first wave that was very early in climate tech that had spent a lot of like, hey, this is going to be amazing. A lot of folks had deployed a ton of money, um, and that didn't work, right? And like, here's the other sort of misnomer: climate tech wasn't venture ready until, I would say, now, right? Like, you want to do stuff in energy, it's private equity, it's pension funds. I mean, these are hundreds of millions of billions of dollars. It's public markets. It's out of the gate. You want to spin up a renewable, sustainable aviation fuel plant. That's $35 million just to get to FID, final investment decision. And so, venture capitalists aren't walking in day one saying, hey, I'm going to burn 35 million bucks just to get to a place where this might be viable. And then you got to get permitting and you got to get tax rebates and like all this stuff. So that takes 7 years, right? Um, so climate for a long time just was like the capital was too tall. And you couldn't expect that it all went well. And for how venture has promised their LPs returns, they were just a total mismatch. You now have enterprises who have figured out that, hey, decarbonizing saves a bunch of money. And that's a good thing. And I can run my business more efficiently, and there's a lot of money in it. Just ask any hotel company who's an operator with a lot of rooms what their light bulb strategy is, and they can tell you. Um, so how they can save energy and how much money it saves them. So you've got enterprises now who have woken up to the idea that, hey, going green saves green and is more profitable. So you have a mismatch because startups, small, tiny companies, were deeply underfunded because they were getting boxed out by the folks that took up lots and lots of capital, right? And now you're like, okay, enterprises want to buy stuff, but it's not there. So you now are in a position where companies are cheaper to start, and you can spend a little less money to get those going to see if they're viable to be enterprise businesses. And you've got a buyer's market on the enterprise side that's willing to buy tech and do proof of concepts and all that fun stuff. So I think climate tech in this iteration is really, really fascinating because the customers are there to consume the products. And it just took some time for the market to mature.
Yeah.
And the US government's throwing in a ton of incentives and all that. And same with the Germans, right? And
Yeah.
all
Yeah,
that.
that's so true. So I mean, probably my last question. You've been through like a multiple successful ventures now, and maybe real fast. If you had to kind of distill down, what are the top three pieces of advice would you give to other founders who are just starting their fundraising journey?
Revenue solves all known problems. Don't run out of money. Don't run out of money. And don't run out of money.
Fantastic, John.
That's all I remember.
Yeah, this has been fantastic conversation. You've given us so much valuable insights into the fundraising journey. Thank you. Thank you for being here and sharing your experience.
Thanks. Have a good one.